Welcome to Home Biz Tax Talk. My name is Lysandra Everett. I am the Home Biz Tax Lady and principal owner of Everett Tax Solutions, where we help you win the tax game. Home Biz Tax Talk airs Monday through Friday, and when you tune into my show, you're going to hear about topics that are important to the home business community. And today we are talking about F is for FIFO. We are continuing our series on the ABCs of cryptocurrency, and we are on letter F. And so FIFO stands for first in, first out. This is an inventory evaluation method. This is a method that is used to specify what your basis is when you're calculating your taxes in cryptocurrency. So FIFO is the first inventory method. There are others. There is also the specific identification method. And so what the IRS has said is FIFO is your default. That means that whatever you bought first gets sold first. Specific identification means you got to identify exactly which coin you're selling or trading for another. Okay, so every time you purchase a cryptocurrency. So let's say, for instance, that you bought Bitcoin in 2015 when it was like $1,000. I don't know what it was in 2015. Just go with me on the example. All right. And so then you bought another coin in 2017 for $4,000. And then you decide to sell. Well, let's say $5,000, right? So that first coin that you bought for $1,000, that's going to be the one that you sell. So you have a gain then if you have $5,000 in proceeds, and then you have that $1,000 that you first bought. That's what goes first. 5,000 minus 1,000 equals 4,000 in gain. Now, if you can specifically identify which particular coin that you purchased, then you can do that, okay? But this is why it's incumbent upon you to know what your basis is, to know when you purchase your cryptocurrency, because it does matter. The amount of your basis is going to help determine your amount of tax when you sell. The lower your basis, the higher the gain, then the higher the tax, right? The higher the gain. So you also have to keep in mind like how long you've kept stuff. Short-term capital gains are taxed at regular income tax rates. So the highest rate is 37%. Long-term capital gains, however, the max rate is 20%, and that's income dependent. So you can see that, long-term capital gains are definitely going to be cheaper than your short-term capital gains. So it's important to know what you're selling and when, and what's going to be the best thing for you to do. This is why, number one, you got to track your basis, and number two, you definitely want to work with someone who knows exactly what they're doing when they're calculating your gains. But back to this, the IRS issued Revenue Ruling 2019-24, where the IRS classified first in, first out and specific identification as the recommended methods to calculate your cost basis. So it wasn't just what Lysandra said. This is what the IRS Revenue Ruling. What else do I want to tell you about that? Oh, also, when there are fees associated with your trades, that also goes to the basis of your coin. So going back to the original example, if you had a $1,000 coin and it cost you, let's say, $100 to in fees, well, then your basis will be $1,100. So that takes up a difference in your gain. I hope that makes sense. But yeah, that's what FIFO is, first in, first out. And if you have inventory in any other type of industry, you already have a good idea of what this is because of how you purchase things and sell things in your if you hold an inventory in other industries. All right, so thank you guys so much for tuning in. I hope that helps you out, and I will see you all next time. Bye.